what do you make of all of these reopening plays right now?
So, Leslie, I think there's still gas left in the tank for these reopening plays. Reopening plays are basically in the value bucket. So when rates started to creep higher, that favors the value bucket, and you wind up getting a sell growth in the face of higher rates, because everyone in the financial industry knows the knee-jerk reaction. Rates move higher, you sell growth, you sell technology. But when you look at what's still left in the tank, we're looking at GDP of 6 or 7%. That's virtually unheard of. We haven't seen those numbers in God knows how long. So who's going to benefit? Hotels, airlines, restaurants. That's how you started the lead there. Marriott Vacation Club. People want to go away on vacation, but they want to be in a timeshare, more of a condo setup versus anything else. But hotels will get the benefit. Airlines will get the benefit. Restaurants will get the benefit. And the other side to this is that you still have checks going out to individuals, and we don't know when those checks will stop. So it's hard to call an end to the reopening trade when the money keeps flowing.
But the money may not have flown to the bottom lines of these companies. Do you think, Steve, just to kind of follow up on that it's already priced into the market, that the market is anticipating that it will ultimately flow down to the bottom lines, since the market is supposed to be at least forward-looking?
So absolutely, and I agree with you. In any other world, any other environment, I would agree that 70%, 80% could be priced in. But we're talking about a pandemic. We're talking about the last time we've seen this was 100 years ago. So there's no real way, Leslie, to gauge past performance is indicative of future performance. So I think the mere fact that we have no clue what government's response will be, how long, how overextended it will be, and where rates will ultimately go, it will push people into risk assets. They'll go into risk-less assets. And when you just look at Peloton or you look at a Zoom that are off over 40% from their recent highs, and when you look at a Planet Fitness that's up 72% from August lows, there's still more in the tank.
Mark, do you agree? Do you think the whole reopening trade is already priced into the market at the moment?
I definitely don't think it's all priced in the market. I think we've had a very nice recovery in airline stocks, hotels, restaurants off the bottom. But I totally agree that there's a lot more to go. I wouldn't get too excited about this one big number we're going to see in GDP. That's just the law of small numbers. We're coming off the greatest drop in history, so the bounce looks really high. I think what has to happen is true recovery, right? People have to get back to normal. And I think that has yet to happen. I think it is happening. And so I think the real key here is the way Advisor Shares goes about it is active management. You know, we're a big believer that we are on the cusp of a pretty significant transition over the next decade toward active management, away from passive, away from indexing. And that's really going to favor these types of ETFs.
Well, what you just said is that, are you saying that basically there should be more active management with certain more targeted ETFs? Because when people hear ETFs, they think of passive management. So you're saying that as an active manager, you should be pursuing more of these thematic targeted ETFs in your investing approach.
Yeah, look, I think the days of cap weighting being in charge are over. I think it's going to go back to the days of, again, active management winning, more of an equal weighted approach, more of a value biased approach. And look, passive isn't passive, right? It's just slow active. You know, over 30 years, 85% of the names in the S&P turn over. It's just that cap weighting is a momentum strategy, and momentum works when there's lots of liquidity. I think that liquidity is going to start to slow. I think we're actually going to talk about a topic here, inflation, which is going to cause some stress in the growth part of the market, the cap-weighted part of the market. That's actually going to be another tailwind to these types of companies, which will have some pricing power for the first time in many years.
Yeah, I'm sure it would be a welcome aspect for them. Maybe not some others, namely the consumer. But Tom, how do you see investors using some of these reopening ETFs as a tool for hedging? Is it used in the same way as more of the broad-based ETFs might be used?
Yeah, well, first, I couldn't agree more with Mark coming out of the financial crisis, if you bought the S&P 500, it would have been really tough to beat it. But then as we got into COVID, we realized that there were opportunities in certain themes or certain asset classes. And back to what Steve was saying, value for the first time in a long time is seeing some love. So if you are opportunistic, and it doesn't mean that you have to pick the individual constituents within an ETF, but if you can actually pick certain themes or certain asset classes that tend to be maybe trending in the right direction or unloved in the past. I mean, for example, when we're seeing the GDP numbers come out, a lot of that is going to be based on the backs of small companies. 65% of GDP is on the backs of small companies, that they are nimble, they can turn very, very quickly, and they also have pricing advantages where everybody's got this desire to get out there, spend their stimulus checks. They don't have to be really tight on their pricing. They can actually put a little bit of leeway in there, which can lead to greater profitability. So I think what these guys are saying is what's happened in the past, especially as far as passive is concerned, worked really, really well. But if you're opportunistic in certain themes or certain asset classes in this opening trade, you can really do much better.